Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Thank you once again for hitting that download button and playing my podcast wherever you might be in the world. If you're out in a kayak somewhere on a river, if you are driving in your car, running, or riding your bike, wherever you might be, thank you so much. I really do appreciate all the support. I appreciate the feedback. Please keep questions coming to Kraig, Kraig, at kraigstrom.com. I do my best to get back to everybody who sends me an email as quickly as I can. You heard it. I am the income engineer. My mission, my focus is to deliver that retirement income conversation that is missing in general, just absolutely missing in general. I really want to help you answer those questions about investments and diversification and asset classes and dollar cost averaging and all those things that are buzzwords out there in this retirement planning and Wall Street machine. But what do they really mean, and how do they all connect, and are they right for everyone to be in this and that? Those are all great questions, and I really want you to be prepared to answer them, to be prepared to ask those questions, for example. I love the conversation around retirement income planning, pre and post-retirement, meaning if you're 5 to 10 years away from retirement or 20 or 30, that's pre-retirement. I love that conversation because there's so much you can do outside the conventional Wall Street wisdom to get yourself ready for a substantially better retirement income plan. If you're already in retirement, post-retirement, there are things that you can do to increase and enhance the retirement income that you are used to if you're just doing it on a Wall Street plan. I'm here to tell you that products are not the answer. A singular product or multiple products, they're not the answer. Life insurance isn't the answer. 401ks, investments in general, real estate, IRAs, Roths, all of these things can be great, can be good. They're just not individual solutions to the retirement income problem, and that's what I'm all about. But if you have questions that range across the board, for example, IRAs, Roths, 401ks, 401k rollovers, what do I do with my old 401k? I can help. If you have questions about, hey, is my investment account in line with where I say I want to be? I can help. Let's do an investment portfolio risk analysis and review your personal risk number to make sure that it matches up. Life insurance, I can help. I'm passionate about life insurance and disability insurance and long-term care planning. I'm passionate about all these different areas of protection, and I can help. Please, if you have questions about any of these areas, send me an email, Kraig at kraigstrom.com. Don't forget, that's Kraig with a K. Quick disclosure, because I'm going to dive right in today. I am not an attorney or a CPA. I am a certified financial planner professional, as qualified as I might make myself sound here on this wonderful microphone and podcast. Please don't act on advice that you hear on this show. Especially, please don't act on things that you hear on financial entertainers' shows. People who are not licensed, who are not regulated, who should not be giving out financial advice. Please don't act on things that you hear on those kinds of shows, even on mine. Meet with a qualified financial planner, hopefully me, before you implement anything that you might hear on one of these shows. Would love to talk to you about your specific situation. I'll give you a great example. Okay, so great example. I met with some folks who were introduced to me by their CPA, and I asked the same question I ask all the time, and you'll hear me mention it later as well. I asked, what's a big priority for you? Well, we're trying to figure out if these annuities that are being recommended are the right thing to do. And I said, well, annuities, what are they for? They are IRAs. Okay, well, IRAs, individual retirement accounts, can come in many different shapes and sizes. You can have investment accounts that are IRAs. You can have basic certificates of deposit, basically kind of accounts at banks that are IRAs. And in this case, they were being advised to purchase guaranteed annuity accounts that were IRAs. And I asked the question, what's it for? Well, we want to lower our tax bill. So these are IRAs. We want to lower our tax bill. Well, they're going to be able to put in $6,500 per year. So they'll be able to put in $13,000, husband and wife, and that will be tax-deferred money. So tax-deferred money. So this is that kind of stuff that I'm talking about, right? When we talk about make sure that you meet with someone to go through and review in a detailed conversation, because what they were getting was a pitch to buy annuities. Now, guaranteed annuities by themselves, good, great, I love them. They're awesome. My mom has them, no problem. But now I go deeper. I don't just go after that one thing. I want to know a bit more. And as it turns out, the idea that this husband and wife would put $13,000 into these IRA accounts, whether they're annuities or not, it just was so irrelevant to their bigger picture. They actually have a substantial long-term planning opportunities that were completely overlooked by the financial advisor who was just wanting to sell them that singular annuity sale. And by the time we were done in a longer, deeper dive, we're now scheduling meetings with myself, advanced estate planning attorneys. We're going to plan a much deeper conversation to help them with taxes in a far greater, much more impactful way than two small annuities that are IRAs. That's not to say that guaranteed annuity is still not a bad idea. It's not a bad idea. It's just that it's a incomplete conversation. So when I say meet with a qualified financial planner, really, we're not all created equal. Some of us have 20 years on the job. Some of us actually do ask questions that go way beyond just individual product conversations. And you miss out if you don't have those detailed conversations before you act. Now, jumping in, watch your step. My first segment in the show has always been watch your step. Last episode, I talked about what is your risk number. That if you're out there investing, and I have a number of people I've talked to lately, because what has the stock market done in the last 7 or 8 years? It's just gone up and up and up. And people talk about their investment portfolios like they're a rock star. My investment portfolio is awesome. I'm earning X and da-da-da-da-da. That's great. But there's no magic here, folks. The reason the investment portfolio world has gone up in the last 8 years, it's because the investment world has gone up in the last 8 years. I would encourage you, rather than falling victim to complacency and just sitting there and, yeah, this is the way it is, it's great, double check your risk analysis. Get a free portfolio risk analysis done through my firm or your firm. This is where you can actually get your personal risk profile number and then run your portfolio risk analysis so that you can determine whether or not they match up. I would suggest to you that they may not match up. A lot of folks will take much greater risk when their portfolio is doing very well. They'll take a risky portfolio and they will mistakenly and intentionally sometimes ignore the fact that, yeah, it is a lot riskier than I normally would have. Well, now is a great time to double check your personal risk profile with your portfolio and make changes. It's now a great time. It's a great time anytime. So last episode, if you want to hear a deeper dive into the portfolio risk analysis, please check that out. If you heard enough right now, send me an email, Kraig@kraigstrom.com. Say risk in your subject line, and I will send you the link, and you can begin with your personal risk profile, and then you can plug in your portfolio. Now, this week, I heard a financial group on the radio in one of my wonderful Southern California traffic drives, and they were advertising their latest workshop seminar, right? And one of the highlights in their seminar was, we're going to show you why a 30-year mortgage in retirement's not a bad idea. What? I got a financial advisory group that's going to tout the idea that a 30-year mortgage is a good idea in retirement. Now, I've got a quick take on this. I always like to ask, what's the motivations behind such advice? What is the motivation behind a Wall Street-based financial advisory firm suggesting that clients go into retirement with a mortgage? Well, let's think about it. If you have a $300,000 mortgage and you can afford the mortgage payments in retirement, but you're just fundamentally, you can't stand the idea of having a mortgage in retirement because that's just not the way you were told to do it, and you want to pay off your mortgage, and you have $300,000 in an investment account with your investment advisor, and you want to take $300,000 and pay off your mortgage, you could do that, right? But what happens to the investment advisor's annual fees for investment management? Yeah, that's right. They lose $300,000 in investment management revenue, fees, etc., right? That they can charge fees on. So does it now start to make sense why investment advisory firms might be recommending or building a conversation around, why is it not a bad idea to keep your 30-year mortgage, right? Because here's the idea. If you keep your 30-year mortgage, well, I'll just make a better rate of return for you, Mr. or Mrs. Client, in my investment portfolio, right? That's the idea. I get it. I understand. I'm not suggesting that that's actually wrong. I do believe that if you have to have a mortgage in retirement, it is better to have a 30-year mortgage, right? But let's face it. If you have a fresh, new, nearly new 30-year mortgage at the start of your retirement, you will basically be paying rent, taxes, maintenance, and repairs on the house that your kids will inherit when you die. You'll basically be paying all of the expenses associated with maintaining your children's inheritance. You'll basically be paying for life insurance because you're going to leave a big asset behind. You're going to give them this great tax benefit as well, but you're going to give them a house. You're basically paying for life insurance in the form of a house with a roof on it and such, right? That's ultimately what you're doing when you're paying for a house with a mortgage. You're really just maintaining your child's inheritance. So why not pay as little as possible to do that? Meaning, if you have to be in retirement with a mortgage, gosh, please don't be in retirement with a 15-year mortgage, because 15 years of your retirement at the beginning, that's the time when your hips and your knees and everything still works and your eyes still work and everything's great. Get out there and enjoy retirement for the first 15 years. And if you're stuck with a 15-year mortgage payment, which is twice what a 30-year is usually, you're basically burdened by this extra payment to pay for your kid's house, right? That's the idea. So why not pay as little as possible? Get a 30-year mortgage, right? Now, if your mortgage is nearly paid off, I usually suggest an alternative. Rather than take the next 10 years, let's say you had a 30-year mortgage and there's 10 years left. As you begin your retirement, there's 10 years left on your 30-year mortgage. Remember, that's 10 years into retirement that your cash flow, your monthly net pocketable, spendable cash flow will be eroded by the mortgage payment, right? Why not consider a reverse mortgage rather than a 30-year mortgage? A reverse mortgage just stops the payments. Right? So now you're not making a mortgage payment. You still have to pay taxes and insurance and maintenance, but you don't pay that big monthly mortgage payment anymore. You can spend that on travel. You can spend it and enjoy it, right? So let me stop for a second, because a lot of folks say, well, I'm a reverse mortgage. I'm not getting one of those because I want to give the house to my kids. Well, consider this just for a minute, okay? Just for a moment. If you consider a house as an asset, and you just think about any other asset, would you buy this asset if it was described as it really is? So this asset pays you no income, it pays no interest, it is risky, it can lose significant amounts of value based on the market, and it has no liquidity. It doesn't have an easy liquidity feature. To get any money out, you have to die and your kids have to sell it, or you have to ask a banker for a loan and permission to have your own money back. No one would ever sign up for an asset if you described it that way. No one would ever want to buy that investment asset from me if I tried to sell that asset. Hey, would you like to buy my investment asset? It has no income, it pays no interest, no dividends, it's not liquid, it's kind of risky, and if you want any of your own money back, you need to fill out this paperwork and go through an approval process before we give you any of your own money back. Well, nobody would go for that, right? I mean, that's just crazy, but now we get irrationally, we lose our minds a bit and we say, oh, no, it's my personal residence. It's a house. It's different. No, it's not. It's just an asset, right? In most cases, it's the largest financial asset that someone has, and we've been programmed to think that we should forego any benefit other than the protection from the rain so that we can give it to our undeserving kids who didn't earn it with years of hard work. We've been programmed that that's what we're supposed to do. You're supposed to leave that house behind as an asset. What did I say earlier? That if you're sitting on a paid off house and you're paying taxes, thousands of dollars in taxes, insurance, maintenance, upkeep, etc., on that house, let's say it's worth $500,000. It's worth $500,000 and you're paying taxes and insurance and maintenance. Where does that house go? It goes to your kids. You're basically paying for life insurance for your kids, right? My plan personally is to move into our forever home someday. The forever home, by the way, is a single story level entry, meaning no stairs. Single story level entry, meaning I could roll my wheelchair in the front door if I needed to, right? And then reverse mortgage the house for an additional stream of income that my wife and I can enjoy. My cash value life insurance, my permanent life insurance, will take care of my legacy. I am not going to have my house be my life insurance. I will let my life insurance be my life insurance, and my house, I will enjoy as much of that thing as I possibly can. Because let's face it, do your kids really want your smelly old house? No. What do most kids do when they get the house? They sell the house, right? After all this time, I'm going to keep the house to give it to my kids. Well, I'll tell you what they do. They sell it. Because they don't want the house, or they've moved away, or you've got 3 kids and they can't agree and they end up selling it. So please, watch your step. don't get sucked in by sales pitches like 30-year mortgage in retirement's not a bad idea. Well, look at the underlying motivations from an investment advisor perspective, and you can understand very quickly why they might want to pitch that idea, okay? Now, don't forget, freeze your credit. Identity theft is rampant, absolutely rampant out there. If you want the links to freeze your credit, send me an email. Kraig@kraigstrom.com. I am happy to send you back that email, and I'll send you back the link with all 3 credit bureaus, and you can freeze your credit. Now, segment 2, listener questions and Kraig observations and rants, right? So last week, a great question from someone who said, my husband and I own 5 rental properties, and they're concerned about getting sued. This conversation on last episode was a deeper dive into asset protection. Good Lord, folks. Over 50 million lawsuits in the United States every year. If you have not had a conversation with a team like mine on asset protection, if you believe that an LLC is a silver bullet for asset protection, I'm here to tell you, you are wrong. Go back and listen to that episode and then reach out and chat with me and my team. We offer free assessments. Don't miss out. Asset protection is not simply getting a Nevada LLC. That is not true, and a lot of folks live under the myth that it is. Now, this week, I had a client question. So a new client, I met with a new client, a husband and wife, and I asked them what was their hot button issue. What's the top hot button item for them? And the number one thing on their mind was college planning for their son in 2 years, and then their daughter 2 years after that. They had attended a workshop with a group promoting college cost reduction planning. That sounds good. I love it. There are some great strategies to reduce the cost of college. Now, they said it sounded good, and they offered a variety of services, but they wanted $3,000 for their program. And they were coming to me and asking me for my take on the college planning process. Now, this could take a long time, and I could rant about this for a long time on my feelings pertaining to college and higher education in general. Let me just say this, that the world has changed dramatically since my college days. The days of get good grades in high school, go to college, get a degree, get a job, work for 30 years, and retire are not a reality for many people nowadays. It's just not the same world. The education system is extremely different for one, okay? It just is. I'm not saying that going to college is a bad idea or that it should not be a priority. To the contrary, I believe strongly that it can be a tremendous benefit if kids go to college with a game plan. If they don't go to college with a game plan, a beginning, middle, and end, an outcome, a future plan for college, there's no point whatsoever. Really, it's just a huge waste of money and a huge waste of time. Okay? So here are some of the key points that I shared with this eager couple who are worried about college and getting their kid into college and paying for college, right? For me, my perspective, the best way to save money on college is to prepare your child for a 3 to 4 year college journey instead of a 5 to 6 year college plan. Staying in school for 1 or 2 years longer means that you and your student may be deeper in debt and wait 2 more years to start earning a great income. That's the key. Get out of college as soon as possible is the number one way to save money on college. That's simple, but it's so overlooked. people don't realize that nowadays, depending on the school you go to, sometimes getting the necessary classes can be challenging. It's almost set up in such, not almost, I'm going to just say it. I believe that the university system so often nowadays, the colleges and such that are out there, they know exactly what they're doing. They schedule certain classes only on every other semester or every other year, and they are setting it up so that kids end up stuck in school longer so they can charge tuition for a longer period of time. Some schools are really good at teaching kids and graduating kids. Others are just really good at teaching them, and they keep teaching them and slowly teaching them, and then they don't graduate on time, right? So the best way to save money on college is to go for the 3 to 4 year college plan instead of the 5 to 6 year plan, right? But what if my child wants to be a doctor or get a master's degree? Well, great. They better be getting a master's degree or a doctorate in a specialty that pays enough that they can handle the debt load from school on their own. That's my perspective. I do not believe that it is smart for moms and dads to let their child hurt them financially. That's just not a good idea. That's a recipe for a bad example, right? I have met people, though, with 2 master's degrees, $200,000 in school debt, and they make $100,000 a year. That's a terrible plan. 2 master's degrees and you make $100,000 a year? I've met people with 2 master's degrees, and they clean pools for a living and make $100,000 a year. Yeah, make $100,000 a year cleaning pools. That's the Southern California lifestyle, folks. Make $100,000 a year cleaning pools. But why bother with 2 master's degrees, major college debt? Why not just go clean pools, right? I mean, why waste the time on 2 master's degrees or a master's degree? Or for crying out loud, why waste a whole lot of time at all? Why not just go make $100,000, right? That's a terrible plan, right? Listen to this. I know heavy equipment mechanics. Heavy equipment, big machines, tractors, trucks. I know heavy equipment mechanics that make $200,000+ a year. They have zero school debt, and they get all major holidays off, and they have great benefits. Come on. So there is no correlation between a 2-year, 4-year, 6-year, 8-year, 20-year degree if you have no plan to translate that into a really good income commensurate with the degree. So what? Why bother? There's no point, okay? Please, here's another point that I share all the time. Get over the stigma of community college. I love this. When I hear it, I just think, it had to be the 4-year university systems planting this idea in people's minds. Oh, you're going to community college? You couldn't get into a 4-year university? Oh, that's too bad. Yeah. That means you're somehow on a lower rung in the ladder, that you're not going to a 4-year college. BS on that. That is so wrong, right? My own daughter was pressured by, let's just say, another family member to go to a 4-year college directly out of high school. My wife and I both suggested that she was not ready for the big college. She wasn't ready for going to a 4-year college, and that community college would be a better starting point for her. No. We know best. The other family member, they know best. And my daughter headed off to Northern Arizona University in Flagstaff, Arizona. Great school, but here's the fast forward. Late in her sophomore year, we got a call from my daughter. My wife and I got a call, and where she's on speakerphone, and she said, "You were right. I should have gone to community college first." And we settled in on the reality that she finally got it. It took her, freshman and most of sophomore year to figure it out. but she actually went and enrolled in community college in Flagstaff, Arizona, and her college experience was revitalized. It was recharged. She knocked out required courses, saved a bunch of money, and felt so much better about the process. The professors were nicer. The school was great. Everything just felt better. She was invigorated about college again. Community college is one of the best cost savings strategies available. It also gives your kid the opportunity to more gradually go from the cocoon of high school to the full-blown college life, which can be hard to handle for some. And it was for my daughter. And did I mention that the cost of community college is hugely better than the university? Wow, what a big deal. And that actually felt great for my daughter. She loved the idea that community college was so much less expensive because she really does feel responsible for getting out of school as soon as she can. And she knows that any extension to that timeline costs us money, right? And her money and time when she's not out earning a wage, okay? Now, another point that I bring up all the time with the college question, financial aid mistakes to avoid. So here's a few examples. And by the way, this is a much deeper dive than is available to do on a podcast. Much deeper dive, okay? So please, if you have a student coming up on college and you want to have a conversation about college cost reduction, I love it. Totally into it. Send me an email. Kraig at kraigstrom.com, Kraig with a K at kraigstrom with an M.com, and put college in the subject line. Let's get together. I'll send you back my calendar link. Let's talk. I have an online calendar we can book straight away. So now, financial aid mistakes to avoid. So here's a few. Yes, if you make too much money, income, you will not be eligible for aid. Very simple, wage-based. The aid formulas go, nope, sorry, no aid for you. No, if you own a business, you do not automatically include that as part of your assets. On the FAFSA form, the free application for federal student aid, FAFSA, you don't automatically include your business. There's some very specific guidelines to what business assets you put on there. Yes, there are assets that are not reported on the FAFSA. Lots of detail here that could improve how much aid your child is eligible for. Please send me an email there. But not all assets are reported on the college aid forms. There are certain types. Notice I said very specific, certain types of LLCs and company entities, life insurance assets, certain types of assets that are not reported on the FAFSA. Okay? Yes, 529 accounts reduce the amount of aid you will be eligible for. What? That's right. If you followed like, I got my 529 account all saved up, well, that's great, but that will reduce the amount of aid you get, period. Well, what if grandma holds the 529 account? Yes, if you held your 529 money in a special entity or in the right kind of life insurance assets, for example, or with grandma, right? The money is not counted against your financial aid. But don't run out and just transfer your 529 account to grandma or buy life insurance. Because it's a common hook with college prep outfits. It can be good, but it's not for everyone. Let's talk. Send me that email. We'll talk about your situation. But yes, 529 accounts will count against your kids' financial aid calculations, even if they're held by grandma in the future. Assets held in your kid's name, big no-no. Hear me. Assets that are held in your child's name are counted exponentially against financial aid calculations. And avoid excess cash on hand that is reportable. Okay? If you've got a large amount of extra cash sitting in banks and such, that will be a complete reduction of your financial aid calculations. And there's no hope of financial aid, right? No hope of financial aid does not mean there's no hope. Here's a great example. I'll give you a great example. So, some folks that I met had inherited mom and dad's beach house. Now, they looked at the beach house as something just as a childhood memory. They had not really looked at the beach house as anything other than a wonderful childhood memory, and they've spent many, many years going back to the beach house to see mom and dad. And mom and dad eventually, they passed away, and they left this beach house to their daughter. So now the family, they're working, they've got kids in school and soccer and everything else, so they don't get to the beach house very often, but they've really understand now that, wow, when they inherited that beach house, they inherited this amazingly expensive, valuable piece of real estate here in California. Very expensive nowadays here in California to get on the beach somewhere, right? On the water somewhere. Oh, crazy expensive. Now, what they didn't know is that they could, right? So I said, do you rent out the house? Oh, no, we don't rent it out to anybody. I said, but could you stand at least renting it out for 14 days? Because remember, the conversation was, how are we going to pay for our kids' college? We make too much money. We're not going to get any financial aid. It's going to be so expensive. Well, I said, well, wait a minute. You have this beach house, right? You don't really want to sell it. You don't rent it out. So it's just a tax and expense and such you have to pay on it. Yeah. So could you at least rent it out for 14 days? Well, why 14 days? Well, the tax law says that if you have a vacation home, you can rent it out for 14 days or less. It has to be no more than 14 days. But you could rent that for 14 days and you could collect whatever amount of rent you can get for that 14 days is tax-free. Tax-free. A place on the beach like that in California could rent out for $8,000, $10,000 a week. A week. And you could rent it out for 14 days? Yeah. You think you could find a way, or maybe some people to rent that out to for 14 days, and you get all of that tax-free income on the beach house? Would that help to offset the cost of college? Yes. Such is life, right? There are ways to pay for college in a more advanced perspective. There's also advanced tax planning that should be considered, right? You can turn hobbies into business. You can hire sons and daughters and shift income to them in your business, right? There's different things that can be done. Don't miss out as well. A couple more points here. Don't miss out on local resources. I'm part of the Rotary International in my local community. And I can't tell you how many times I've been sitting there in the club and I hear that we had a scholarship for local high school students, an education scholarship that went unclaimed. No applicants. One time I heard we had $2,500 in a local scholarship available for education, and it required an application and an interview. No applicants. Unbelievable. Free money just sitting there from a group like the Rotary that just wants to give it away. Please, don't miss out on the local resources. There's tons and tons of local resources with $500 to $2,500 to $5,000 scholarships, $1,000 scholarships. Those go a long way. When you look at the overall ticket of college, those go a long way to help offset. Now, the biggest thing I stress, the biggest thing that I'll finish with, the most important part about going to college, that I talk to parents and students about this all the time, is your network, is a great network. It does not matter if you come out of college at Harvard or ABC Technical School, if you don't have a network. Yes, if you have a degree from Harvard, that will give you a leg up in many situations when it comes to specialty fields like law and accounting, for example. But if you do not have a network of connections, if you do not have a LinkedIn profile in your degree field, if you don't have a network in the field that you're coming out in, others who are more connected than you are far more likely to step in front of your child in line for that job. That is a fact. That is an absolute fact. When you really think about it, if your child comes out with a degree from Stanford and my child comes out with a degree from Northern Arizona University, definitely Stanford sounds so much more prestigious. Absolutely. But if they go for the same job interview and my daughter is already connected to the director of admissions, is already connected to 5 different alumni from Stanford who have made a little email introduction for her before the interview, I don't care if your daughter came out of Stanford and mine came out of NAU, my daughter's getting that interview nailed because of her network, not because of the school she went to. That's the reality, folks. Make sure that your kids don't miss networking on an adult level. Not Snapchat, not Instagram, not Facebook. LinkedIn. That's going to wrap it up today. There's so much more to that college cost reduction and planning conversation. If you are thinking about 2 years out, 1 year out, 3 years out, now's the time to make some decisions. I love that conversation. Send me an email. Let's get on the calendar to talk about that. Remember, you've got to check this stuff out sooner than later. You have to do it 2 years out if you can, but don't stop now. Even if you're right up against the wire, there are things that you can do and strategies that you can put in place. Really appreciate everybody sharing. Thank you so much for the questions and the feedback. Please keep them coming. I really do appreciate them. I do my best to respond to everybody as quick as I can. That's going to wrap it for Personal Pension Radio. I'll talk to you again real soon.
Thank you for listening to the Personal Pension Radio podcast. We took notes for you, so if you missed any part of the show, you can find a full transcript of each episode at personalpensionradio.com. Be sure to download your free retirement income crisis report at personalpensionradio.com. While you're at it, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.